Let's bring in Brian Weinstein. He's head of fixed income at Morgan Stanley Investment Management. And here on set with me is Chris Grisanti, chief equity strategist at MAI Capital Management. Welcome to both of you. Chris, I'll start with you. Why do they need to keep hiking?
Well, you know, Kelly, I think the economy is still quite strong. It's an ocean liner. We've had an inverted curve for just about 6 months. It usually takes a year or more for things to really slow down. So they've really got their work cut out for them. There's still several hawks on the committee. I think you're going to see a hike in June.
Well, let me kind of ask it differently. Or sort of phrase it differently. Maybe everyone thinks they will hike, but should they? I mean, you're worried about a hard landing already here. I am. And having said that, I think the Fed's between a rock and a hard place because they can't be easy on inflation. If they get, by the way, the employment and the CPI numbers will come out right before the meeting. That might give them the excuse to hike that I think they're going to use. Or maybe the excuse to pause, or do you think that's, or
no,
skip, or whatever?
I think we're still going to see strength.
Okay. All right. Brian, I turn to you. And maybe that, I mean, only that really would explain bond yields at these levels, don't you think?
Yeah, I think that's right. I mean, as someone who thinks they should pause, and even Jay Powell was out, yesterday, the day before, saying that there's some evidence they should pause. I think it's hard, right? I think the risk markets are saying they need to go, and I think the way they played the transitory card on inflation, too soon and maybe incorrectly, they need to show they're tough on inflation here. The market gives you an opening, you take it. I'm not sure they want to hike, but I do think another one is in the cards.
But so you basically said you actually don't think they should keep hiking, but just that they will. So what do you see that you're worried about?
I think there's a tale of two markets here, right? I mean, I think if you're a smaller business, if you're looking for a regional bank to lend to you, I think it's tough, right? I think credit conditions have gotten much tougher. You can see it in survey data. If you're a large company, it feels pretty good, I think, right? Especially a tech company. So I think the Fed, the evidence that they've pointed us to, CPI and employment, continues to move along in a way that suggests they need to hike. Unless they point us another direction or the data changes dramatically in the next few weeks, you get another 25.
I mean, we'll wait in a moment for the results of this auction. But, Brian, are these yields a gift? I mean, who wouldn't? And Chris, I'll ask you as well. But, OK, so you can get upwards of 5%, I think, beyond the 6-month bill. I mean, maybe on the 1 year at this point. And yeah. I just don't understand why the market keeps offering what seem like such, kind of shockingly high, like a gift, like practically a gift for people to take.
Right. Well, Kelly, you and I have discussed this before. I mean, it's happening. Money is moving to the front end of the yield curve. Money market fund flows are great. People are buying T-bills, opening up Treasury direct accounts, or buying funds. And I think that's the right part of the curve. I think out the yield curve, where the market is really looking for the Fed to ease quickly, we're starting to struggle there, right? We got 10-year notes to 330, 335. They're back to 375. Tight range. But actually, I think the market is questioning whether or not the Fed has to ease quickly. So it makes that cash market even more attractive in this environment. I think you'll keep seeing it. I do think it's a gift. I think it's a good place to invest money.
Yeah, I've been surprised by the strength in the 10-year part lately. I mean, almost 375 today.